style will struggle the most if the economy continues to be on edge. While growth investing struggles when the economy is unstable, volatility investing thrives. People like Michael Burry from The Big Short love these types of conditions. I'm not sure if you've watched the movie The Big Short, but essentially in that movie Michael Burry shorted the housing market in 2008 and made a bunch of money as the market fell. Michael Burry profited from volatility. Volatility investing. You can either do the Michael Burry approach and short stocks on the way down, or you can do the George Soros approach and ride stocks on the way up. He also short stocks on the way down, but he does ride stocks on the way up. This approach can be quite risky, and you need to have your finger on the pulse at all times, but if done right it can make a lot of money. Those are the 5 styles to investing in the market. If you want to see the styles that I personally implement and the way my portfolio looks like, there is a link to that in the description below for premium viewers. Have you ever been on those stock websites and you see hundreds of ratios and numbers everywhere on a screen? Yeah, it can be pretty confusing for an experienced investor, let alone a newbie. So let me explain some key ratios and numbers to know if you understand them already. Skip to the next one. A good test for you all to do is how many of these 12 ratios and metrics do you already know? Okay, tick them off the list as we go. So price per share or price per stock simply tells you the price that will cost you to buy a share. Pay that price with your stockbroker and you will become a shareholder. The market cap of a stock tells you the total value of the business. Market cap is calculated by getting all of the shares in the business and multiplying it by the price of those shares. For example, Apple's market cap is $2.3 trillion. So if you wanted to buy the entire business of Apple, you would need $2.3 trillion. Tesla is $525 billion. Netflix is $140 billion. The dividend yield compares the price you pay for a stock to the yearly dividend it gives. So if the dividend yield is 1.5% like it is with Walmart, if you bought $100 worth of Walmart stock each year, you would receive $1.50 in dividends. Right now the average stock on the American market has an average dividend yield of 1.66%, so use that as your benchmark when looking at dividend stocks. If you ever see the letters EPS, that stands for earnings per share. Earnings is the same as profits, aka revenue minus expenses. Obviously you want earnings to be as high as possible, get the most profit, the most money as possible. The PE ratio is one of the most important ratios to know because price in and of itself is not important. Price relative to profit is very important. The PE ratio compares the price you pay for a stock to the earnings that that stock brings in. All else remaining equal, you want the PE ratio to be as low as possible. If you have a PE ratio of 6, that means if earnings stay the same for 6 years, you will get your money back. After that period, you'll get your money back in 6 years. The price to book value compares the price you pay to the book value you get in return. Book value is the value of the stock on paper. If you were to sell all of the assets of the business and pay off all of the liabilities, the book value is what's left. You want the price to book value as low as possible. Back in the day, Warren Buffett used to buy stocks that had a PE ratio below 1. This means he could buy the entire business, sell it off, and also make a small profit because the price he paid was less than the net asset of the business. He used to call this the cigar bar approach, where he would find a smelly used cigar on the ground, smoke the last puff of it, get that final bit of value, and then discard it. Remember, as I said earlier on, that a business's main goal is to make money. One way to judge how good they are at doing this is by looking at return on equity. So equity equals assets minus liabilities. Basically how much money is in the business in terms of net assets. Return on equity is the percentage return in profit you get on that equity. If you have a high return on equity, it means that the business can get money and generate it into more money at high rates. It means basically that it's a good business. I recommend a stock to have a return on equity of at least 10%, and Buffett likes return on equities above 15%. You can find the return on equity metric by going to Yahoo Finance, go to the statistics section and scroll down to return on equity. The price to earnings ratio, as I said before, it's a great metric, but it's missing one key component: the growth of those earnings. This matters because if earnings are going to double each year, it affects the value of the stock and the return that you'll get in the future. The PEG ratio takes into account growth of earnings. It is calculated by dividing the PE ratio by the growth rate of earnings, and just like golf, you want this number to be as low as possible. The lower the PEG ratio signals the cheaper the price, the higher the earnings, and the higher the estimated growth. You can find the PEG ratio by going to Zacks.com to fundamental charts and click on the PEG ratio. Also, a lot of these ratios in general will come up when you type in the stock and the ratio that you're looking for on Google. Funnily enough, Google has the answers to a lot of things in life. As a business owner, two of the most important metrics to look at is 1, revenue, aka how much is the business making in total, and 2, earnings. After I deduct expenses from the revenue, how much do I actually keep? You want both of these numbers to be obviously as high as possible, consistent, and also very important growing. Yahoo Finance gives you a nice overall picture so that you can see what's happening with these numbers. The green is revenue, the blue is earnings. So this is Apple stock. As we can see, both have grown nice and consistently did very well in 2021, but also slowed down slightly in 2022. Also, you can go and check analyst estimates for how much they expect revenue to grow by in the future, and you can check how much earnings are expected to grow by if you go into the analysis section of Yahoo Finance. Yahoo Finance is a very good website for investors. By the way, now if there's one thing that we learned in 2022 is that debt is a dangerous game. Just go ask Sam Bankman-Fried, Credit Suisse, or Evergrande. They'll tell you how much trouble debt can get you into. If you get into too much debt, things can all come crashing down. But how do we tell how much is too much? There are two key ratios to look at to assess a company's debt level. First is the debt-to-equity ratio. This ratio compares how much debt the business has to how much money or equity the owners actually have in the business. Naturally, you want more equity than debt. The current ratio is also very important because it gives you a clue if the business can survive in the short term. The current ratio is a business's current assets minus current liabilities.